All right, so you know those employee stock purchase plans, those ESPPs. They let you buy company shares at a discount. They're pretty great for building wealth, but the tax side can get kind of tricky, especially when you decide to sell. So today we'll go beyond the basics and unpack some smart strategies. Hopefully we can help you minimize your tax hit when you sell those ESPP shares. Now, I'm sure you're familiar with adjusted cost base. It's basically your starting point for calculating profit. The original price plus any extra costs you paid, higher adjusted cost base. Well, that just means lower taxable gain. Makes sense, right? But here's where things can get a little bit messy. Sometimes when you transfer those ESPP shares to a regular brokerage account, that crucial cost base info, it doesn't come along. And that can be a real headache come tax time. You might even end up in a situation like one of our listeners, Frances. She reached out totally confused because her brokerage statement showed a loss, but she remembers the original transfer amount being way lower, so now she's worried she might actually have a taxable gain. So how do we avoid these messy situations and make sure we're paying the right amount of tax, not a penny more? Well, first off, organization is key. Keep detailed records of every ESPP transaction. We're talking dates of purchase share prices, commissions fees, and even those dividends you received and reinvested. Especially those dividends, because if your company has a dividend reinvestment plan, those reinvested dividends actually gum up your adjusted cost base, which of course lowers your potential tax burden down the line. Now, I know what you're thinking, paperwork, but trust me, this level of organization will save you come tax season. And it can help you avoid a lot of stress and confusion. But, sometimes life happens. We're not all perfect record keepers. If you find yourself in that boat, don't panic. Your former employer's investor relations department. They can usually provide you with those missing details. Things like share price history, which is super helpful for piecing together your adjusted cost base. Oh, and here's a curveball for you. If you worked for a U.S. or foreign company, you'll also need to factor in currency exchange rates. You'll need those when calculating your adjusted cost base. Those fluctuating rates can significantly impact your gains or losses, so make sure you're using historical exchange rates from reliable sources. Okay, let's assume you've done your detective work, you've gathered all your documents, and you've calculated your adjusted cost base. Like a pro. What next? Well, now it's time to figure out if you're facing a capital gain or a loss when you sell those shares. And remember, you only pay tax on the gains. One smart strategy to minimize those gains is to offset them with any capital losses you might have. You can use losses from previous years. And here's the best part. These losses can be carried forward indefinitely. Imagine them as a secret weapon waiting to be unleashed against future capital gains. Pretty cool, right? But hold on, it gets even better. Let's say you're facing a capital gain this year, but you don't have any past losses to offset it. Well, you can actually use losses that you incur in future years to offset those current gains. It's called a capital loss carryback, and you can usually go back up to 3 years. It's like a time machine for your taxes, letting you strategically adjust your tax curtain. We talked about offsetting gains with losses, but what if you don't have any losses to work with? Well, fear not, because there's another powerful tool in our arsenal. RRSP contributions. RRSPs, or Registered Retirement Savings Plans, are a fantastic way to reduce your overall tax bill. When you contribute to an RRSP, you're essentially lowering your taxable income for that year, which means a smaller tax payment. And guess what? This applies to your ESPT shares too. Let's say you're selling those shares and you know you're going to have a capital gain. Well, making a strategic RRSP contribution can potentially offset some or even all of that gain. For example, if you're looking at a $10,000 taxable gain, a $10,000 RRSP contribution could completely wipe it out. But here's a key detail to remember. Only 50% of your capital gain actually gets added to your taxable income. So in that $10,000 example, only $5,000 will be added. This means you don't need to contribute the full amount of the gain to your RRSP to completely offset the tax. You could contribute $5,000 and still eliminate your tax liability on that $10,000 gain. And there's even more good news. There's talk that the inclusion rate for capital gains might be increasing to 66% in 2026. This means that even more of your capital gain will be added to your income, making RRSP contributions an even more valuable tool for minimizing your tax burden in the future. Okay, we've covered some solid strategies so far, but let's dive into a technique that could be a game changer, especially for long-term investors. It's called selling in lots. So imagine you've been holding on to those ESPP shares for a while, and they've grown significantly in value. You're thinking about selling some to lock in those gains, but you also don't want to get slammed with a massive tax bill all at once. That's where selling in lots comes in. Instead of selling all your shares at once, you divide them into smaller chunks or lots and sell them gradually over time. This strategy has a couple of key advantages. First, it helps you spread those capital gains over several years that can potentially keep you in a lower tax bracket and, of course, reduce your overall tax liability. Second, by selling in stages, you're essentially giving yourself multiple opportunities to take advantage of any dips of the market. So if the share price drops after you sell a lot, you have the chance to buy back those shares at a lower price, so you can potentially increase your cost base and further reduce your future capital gains. It's like a built-in safety net. Of course, selling in lots requires a bit more attention to detail. You need to keep track of which lots you're selling, their adjusted cost base, and the dates of sale for accurate tax reporting. But hey, we're all about mastering those details, right? Now let's tackle a common question. What happens if my ESPP shares actually go down in value after I buy them? Do I still owe taxes? The answer is a resounding no. If you sell those ESPP shares at a loss, you're not on the look for any capital gains tax. In fact, that capital loss can actually work to your advantage. Remember those capital loss carry forward and carry back provisions we talked about earlier? Well, they apply to losses from ESPP shares too. So if you have a capital loss from selling your ESPP shares, you can use it to offset any capital gains you might have made from other investments. Or you can carry it forward or backward to offset gains in other tax years. It's like having a financial safety net protecting you from those unexpected tax hits. As we move forward, there's a crucial point I want to emphasize. Holding periods matter. The amount of time you hold on to your ESPP shares before selling can significantly impact your tax obligations. Advantage of this tax break. It could make a real difference in your overall return. But here's the thing. The capital gains deduction isn't always the deciding factor. Sometimes it might make more sense to sell those shares sooner, even if you haven't held them for a full year. For example, let's say you're anticipating a big jump in income next year, maybe from a promotion or a new job. Selling those shares before your income increases could potentially keep you in a lower tax bracket, saving you money in the long run. On the flip side, if you're expecting a drop in income, maybe due to retirement or a career change, it might be advantageous to hold on to those shares and sell them when your income is lower. You'd benefit from both the capital gains production and a lower tax rate. It all boils down to strategically timing your sale. You have to base it on your individual financial situation and future income projections. And that's where a little foresight and planning can really pay off. Now, before we wrap up, let's shift gears and explore another powerful tool that can help you minimize taxes on your ESPP shares. TFSAs. TFSAs, or tax-free savings accounts, are designed to help your investments grow tax-free. And they can be a great option for managing your ESPP shares. You might be thinking, can I just transfer my ESPP shares directly into my TFSA and avoid paying any tax? Well, not quite. When you transfer shares into a TFSA, it's considered a sale for tax purposes. This means you still need to calculate your capital gain and pay any applicable taxes. However, once those shares are inside your TFSA, any future growth or income they generate is completely tax-free. It's like a financial sanctuary where your investments can flourish without the burden of taxes. This could be a huge advantage, especially if you're planning to hold on to those shares for the long haul. You're essentially shielding all those future profits from the taxman. But keep in mind that you need to have available contribution room in your TFSA to make those transfers. If you've maxed out your TFSA contributions for the year, you won't be able to transfer the full amount of your ESPP shares. In that case, you might need to consider selling some of those shares to cover the taxes, and then transferring the rest into your TFSA. It's all about finding the right balance and making the most of your available contribution room. Remember that knowledge is power. Understanding the rules, utilizing the right strategies, and keeping meticulous records can make a huge difference in your overall financial well-being. Don't be afraid to seek guidance from qualified professionals, whether it's a financial advisor or a tax expert. They can provide invaluable insights tailored to your unique situation, ensuring you're making the most informed decisions. And remember, it's all about finding the right combination of strategies that align with your goals and risk tolerance. There's no one-size-fits-all approach. So keep learning, stay informed, and enjoy the journey of building wealth through your ESPP. Thanks for joining me today, and happy investing.